McCuistion, for over 28 years talking about things that matter with people who care. Production of McCuistion is made possible in part by individual viewers, supporters of the Foundation for Responsible Television, the University of Texas at Dallas, creating the future.
Well, welcome to the program. I'm obviously Dennis McCuistion, and I'm not exactly sitting in a studio, and this is the first time in our 30 years being on the air that we've ever done anything like this. Given the situation, it may not be the last time, but we have a really interesting program to talk about and look at really the oil and gas situation and the economic situation in view of everything that's happened in the last few weeks. So joining me is my co-host, Jim Falk, and Jim, as many of you know, I've seen him lately with us, and he is the CEO of the World Affairs Council of Dallas-Fort Worth as well. And Jim, you're going to introduce one of our guests right now, so why don't you go ahead and do that, and let's talk about oil and gas and where we are.
So to shed light on how COVID-19 is and will continue to impact our economy, we are joined by Ken Hirsch. He's the president and CEO of the George W. Bush Presidential Center, and he's also the co-founder and former CEO of NGP Energy Capital Management, a private equity investment firm. He currently serves as senior advisor to the Carlyle Group's Natural Resources Division. Ken, it's great to see you, and thanks for being our guest today.
Happy to do it. Thank you for having me.
So I was looking this morning, here we are in mid-April at the price of West Texas Intermediate, and it went under $20. And this is just a few days after President Trump was working with Saudi Arabia and Russia, hopefully to reach some type of an agreement to stabilize prices. Doesn't look like that's quite happened. What's your insight?
Well, my insight is I'm 35 years old again, although I got a lot less hair. It is absolutely stunning what has happened in the oil markets. It had started as a price war before the virus pandemic, and then the demand destruction as a result of the pandemic has just been stunning. Let me just give you some numbers to put it, some simple numbers to put it in perspective. The world supplies and demands plus or minus 100 million barrels of oil per day, so it's easy to remember. We right now globally are running a 30 million barrel a day drop in demand. Now, OPEC produces about 30 million barrels a day. So in order to balance the market, normally what happens is price is the governor, and then people respond to the price signals and regulate investment, which causes production to go up or down. A 10 million barrel a day drop in our agreement to pull 10 million barrels a day off the market would not balance the market. So right now we're in this maximum uncertainty phase where the shutdown has created the big drop, and the market understands that that's temporary. So the big question is, when the shutdown is over, where is the new normal in oil demand? We have some early signals of that, because you can look in areas like South Korea and like China where they've reopened, and in Hong Kong where they've started to reopen after the pandemic has kind of swept through. Early estimates may be that it's a 10% drop from the pre-virus normal. So that means we're in kind of a 90 million barrel a day new normal of demand. And so in that market, a 10 million barrel a day withdrawal from the market would be about right to balance the market. So I think that we need to not look at what today's price is, although it is absolutely horrific from a producer standpoint. You basically can't function. So the oil and gas business is no different than the neighborhood restaurant. And you might have a little takeout going and a little curbside delivery, but you're not covering your costs, you're not covering your rent. So you're really slowly going out of business. You're just eating into your cash reserves. So that's exactly what's happened in the oil and gas industry today. And it's probably true globally. There's nobody who can make money and have enough free cash flow to reinvest at today's prices.
So when you focus on what's happening in Texas, I mean, of course, lots of people are losing their jobs in the oil service sector. I read recently how Halliburton is furloughing, laying off truly thousands of people. But what about the actual production and the situation where you're shutting in wells throughout the Permian?
Sure. So the first thing you do if you're running an oil and gas field is if it breaks, you don't go fix it. Okay. But if it's pumping, and doesn't have a very high marginal cost on a day-to-day basis, you basically do what you can to keep it going. And so there are two aspects of I'll call them shut-ins. There's the physical going around and actually turning off your wells. That is you would only do that in really high cost production where you do have daily operating costs in excess of today's prices. The second is just the lack of investment in keeping your production up causes the natural declines to take over. And so the natural declines that we're going to be talking about in the US and in Texas is going to be north of 20%. So it would not surprise me for the United States to lose 2 to 3 million barrels a day of production really starting this summer and moving into the first quarter of next year. But it does take a little while for that to catch up. That's kind of a 4 to 6 month phenomenon. So we'll see the US really start to contract in the middle of the summer.
What type of washout do you think we might see with some of the oil and gas independent companies that don't have the financial strength to weather this storm?
It's brutal. It's absolutely brutal.
Will we see some of the larger companies, the majors, will they be purchasing the assets or the companies?
Well, the wells don't know who owns them. They don't know if the equity owns them or the bank owns them. The wells just pump. Okay. So right now, what the transition is between the companies that have good balance sheets and the companies that don't. And the companies that don't have good balance sheets, ultimately their lenders are going to be now their owners. So then it's going to be up to the lenders who now are their owners to decide, what are we going to do with it? Are we just going to sell it and then put it on the market and see who the buyers are? It's not like there is a process that we go through in this country, thankfully, where we sort this out. And in many cases, what this is not dissimilar to what happened in the real estate business in the financial crisis, where it was amend and pretend and extend, right? And so the banks aren't equipped to operate oil and gas wells. Some of the banks are taking more aggressive stance that I've read, but that will remain to be seen.
Well, one of the things that really financed and supported all this exploration, especially with fracking, was investors. And that money's really dried up, hasn't it? It was already drying up before the virus.
That's right. And we have a market economy, and that's what happens in a market economy is that investment turns off. And when investment turns off, the natural declines take over, and then supply drops. And then now here's the difference. In a normal market, low prices cure low prices and high prices cure high prices, right? Low prices cause the supply drop, but they also cause a demand increase. So in this case, we've seen, gasoline here in town is $1.50 a gallon. I feel like I'm 25 years old again. That to me is also a dramatic signal. Normally that would cause an increase in demand. Okay. And so that will be the real, telltale sign is when demand follows that price signal. And I think that takes a good year to 2 years to sink in.
How important is jet fuel in all of this? Because when you have the aviation industry essentially shut down, and I think, see what you think about this, but I think it's going to take several months for Americans to really, around the world, for people to feel comfortable flying again.
Yeah. And I think that it will. Jet fuel is about 10% of the U.S. demand. So I think that's something that will pick up and be more slow. We just have to wait and see.
Yeah, Ken, let me jump in there because there are, let's just say, events happening here in Texas that might or might not happen and might affect things. And yesterday's Dallas Morning News, Scott Sheffield came out pioneer, and they're talking about trying to get the Texas Railroad Commission to go back to what they used to do, which is controlling supply in order to increase price and all that. How do you feel about that sort of a political move?
Well, normally I'd be opposed to it. I think that is a, it's a drop in the bucket. The Texas produces 4 to 5 million barrels a day, about 4 million barrels a day. If we prorate back 20 or 30% of our production, that's 1 million barrels a day. Remember my numbers, we're a 30 million barrel a day off the supply and demand mismatch. And so it might help. I just, I hate to have the politicians do anything temporary, ask them to do something that's temporary, because then all bets are off when you flip and say, okay, now it's time to turn it back on. How do you do that? And who's in the Railroad Commission at that moment? And, it's interesting to ask for it. It's important to ask for it because we're in pretty desperate times. But the execution of it adds another air of uncertainty. The labor in the oil and gas industry does not belong to the oil and gas companies. It belongs to the oil and gas service companies, the Halliburtons and the Schlumbergers of the world. Those are where the labor lives, and that they are the swing factor. When times are good, the service companies can have really big fat margins, and as soon as times turn down, the producers basically collapse the service companies' margins, and they get hit first. The new drilling has stopped, and so the rig count is a good indicator of employment. And so we're just, it's a sector that's down. I don't want to sugarcoat it because it's bad, but the oil and gas sector has been one of the reasons that the economy had any growth coming out of the financial crisis. And in a dynamic economy like we have, we ebb and flow between sectors, and some other sector picks up the slack when one sector's down. So the oil and gas industry now, the big things to watch is there something that is happening because of this crisis that is teaching us that we can use less people in the oil and gas industry, that something on the backside of this will come out of this with a structurally different industry where there'll be dramatically fewer people. And now, that would be something to grab onto and say that this is something to think about. I don't see that. We had already, in fact, when prices were higher, that's when people want to try to take costs out of the system. And so we've already added the telemetry and trying to, have smart rigs where you have fewer people. So the number of people that were working in the industry a year ago is a pretty good number if we can get back to that level of activity.
Well, I'm showing my age because I was an energy banker in Houston in the early 80s, and our slogan was staying alive till 85. And I feel like we're seeing a little bit of that again, but with one sharp difference, and that is that there is now such an emphasis on renewables and alternatives to hydrocarbons. Is this situation in any way, could it accelerate it?
No, I think it goes the opposite way.
Does it?
Yeah, I think it pushes back. People are going to say, look, high cost renewables is something we don't have the luxury to invest in right now. And if we're coming into a recession, coming out of a depression into a recession, it's going to push it back.
That's assuming the price is going to stay low. Bring out your crystal ball for a moment.
Yeah.
What do you think the price might be a year from now?
I think the price a year from now, I think $50 is an oil price that is a very stable oil price. Below $50, it's basically a subsidy from the producers of the world to the consumers. Okay, because they're not making enough money to reinvest in order to sustain their business. And so that's kind of the stable price. Now that means that you end up with a range. The range is kind of 40 to 80, because the market always overcorrects in each side. And when the market gets too high, which is what we saw, the market was moving into the 70s, and all of a sudden U.S. production was ramping up. And so OPEC looked around and said, we're losing market share because every time we cut a little bit, the US industry increases. And, and so that, they said, well, why are we losing market share? So they dialed up production. And that was they tried to get restraint, but Russia didn't agree. And so next thing you know, they ended up with a price war before the virus.
Will the supply chain, where we're producing so many pharmaceuticals and so many other products in China, now start to come back to America? And if so, how long would that take?
Yeah, and let's put that in context that over 85% of our antibiotics are being produced in China.
Right. Well, I think, let me back up a little bit, because I think what's interesting, and this is just a perspective from my position in the Bush world now. 9/11 was an attack, was a terror attack against the United States, but it was also endemic about the growth of terrorism around the world. And it was kind of a borderless enemy. And so it was an international outrage. It wasn't just an American problem. But it was endemic about the free flow of people and movements around the world, that that's kind of the new nameless, faceless enemies that appeared in 9/11. Here we have a nameless, faceless enemy in this virus. But yet what's happened is it's been treated not as a global enemy, but as a state enemy. And so we've reasserted borders around the world. People are shutting travel between borders. So it's kind of a reassertion. Instead of saying that we all need to fight this thing together, we're saying maybe the smart way to fight this is actually to segment. We're even doing that locally. We're segmenting individually, social distancing. I mean, these are, we're erecting barriers which is quite different than the lessons of 9/11. Now, I'm not saying that it would have been better to have a free flow and more air travel. I'm not saying that at all, because the scientific community is moving data around borderlessly all over the world. So that's good. And we're sharing experiences, because different countries, even different states, are doing the shutdowns a little bit differently and the quarantines, et cetera. So I think that what's endemic now is that it's sort of a reassertion of borders. And in a reassertion of border world, things like supply chains really have a problem. And those are, that's going to be a longer term effect of this. Pharmaceuticals, I'm not in the pharmaceutical industry, so I know what we're all reading. And it does look like that there are trends afoot to say we need to rethink. I think we need to rethink. People are going to rethink their supply chains. People are going to rethink their relationships around the world. A long time ago, when the Berlin Wall came down and we were going to open up Eastern Europe, there was this flood of excitement about a new market that was opening, a couple 100 million people, and it's a new democracy, and here we go into Russia. And people went headlong into Russia, and a decade later, they said that was the worst decision ever made, and they pulled back. And I think people are going to rethink about what doing business in China really means, and now that they've been at it for a decade, yeah, they got cheap supply, but they got their intellectual property stolen. Did they really have rule of law? Are their executives there safe? I mean, did we actually make any money? Have we been able to repatriate it? I think it's a real open question about what doing business, especially in China, is going to look like. And I personally think that it's not all that it's cracked up to be, and it's going to follow a similar path to Russia.
And so all of this begs the question then, Ken, of now the president and some of his advisors are pushing to reopen America, basically, and places around the world are trying to do the same thing. How do you see this playing out in terms of the time frame, and how is it going to work, and what are the risks from your perspective?
Well, I think the first thing is we need to let the medical and the public health community dictate that. That's the first key element. Is that the politicians need to know what they don't know, and me included, and I'm not a politician. I think that we can speculate and we can try to anticipate, but at the end of the day, I think that the public health authorities have to be the ones who are giving guidance. And it's imperative upon every business leader and every faith leader, you name it, every political leader to take their cues from the public health authorities. That said, I think that you can anticipate what may happen. We had a very hard close and we'll have a soft opening. And so I think that from a business perspective, what I'm doing is just doing some scenario planning and saying, is this going to be an 8-week, an 8-month, or a 2-year kind of process? The key question is when, from a full opening standpoint, the key question is, when do we restore confidence? And a vaccine, we have a flu shot every year, and 50 to 60 or 70,000 people die every year of the flu, even with the flu shots, right? But yet we still fill crowded football stadiums and baseball stadiums because we have the confidence that the risks are low, and that if I do get something, healthcare is good and access. So I think that we need to get this back into kind of the box of our understanding, and that'll take a while. But I mean, the public authorities will figure that will really figure that out and guide us.
And let me ask you about how this has affected your work at the Bush Institute, because you're a nonpartisan think tank and you have had some projects with Africa, especially with PEPFAR and other activities like that. So how are you reorienting your work?
Well, it's a great question. I mean, I think we've obviously moved into the digital world, and in areas of focus that we've been most pronounced in, we're trying to reassert kind of the value of those our guiding principles around less government dependency and being a strong and compassionate country at home and abroad, and economic and political freedom. Freedom it could be a big casualty of this crisis, and different people want to clamp down in different ways, and that's happening. That could happen around the world. So we need to be a voice as to why that is not the proper course of action. From a global health standpoint, there needs to be global leadership around that. The United States is the big player. What does that mean going forward? We're spending a lot of time thinking about what that means and what is the new order. We have these institutions that were set up. The WHO is an interesting institution, but then it apparently gets corrupted by political influence with China, and yet we're paying the bill. And so it's a reaction. Now President Trump has had this massive reaction to it. Well, we don't want to throw the babies out with the bathwater either. And if the WHO is doing some good work, how do you discipline the WHO without cutting it off in order to maintain, the distribution channel for that good work? So I think we're spending a lot of time thinking about that. We're spending a lot of time thinking about education. One of the things that being in an online world does is it increases the inequality around between the haves and the have-nots with respect to the tools of education and the way that education is delivered and consumed. The early data on what the second half of the school year looks like this year, and the retention rates of what the students will keep in the K-12 world, what they will retain during their summer, and if they have to go online in the fall. I mean, you're talking about a real lasting impact if people really are moving up a grade, by the age clock, but not by the education clock.
Yeah,
and absolutely. And when you look at colleges and universities, especially in Texas, we have so many international students, and I wonder, one, how welcome they will be, and two, if they'll even be able to come.
Right.
Yeah, and Ken, let me follow up on two things that you mentioned there. One, the idea of what new world we're going to be in. I wrote an op-ed recently and mentioned Bob Higgs' great book, Crisis in Leviathan, which is that every time we have a crisis, whether it's a war or something like this, the government expands dramatically, especially as we've seen with this CARES Act and trillions of dollars from the Fed, and it never shrinks back to where it was before. So we hope that you at the Bush will study that and see if you can deal with that. And then secondly, to pull in your thing on education, I will be teaching tonight online again this week, which is fine. But I use a tool called memory science that will make sure retention actually happens. And most schools aren't using that. And we've got to, as you say, we've got to have retention. If you don't remember something, you haven't learned it. So we just have a couple of minutes left, so we'll let you finish with that, and then we'll close.
Well, I think that, I think what we're going to try to focus on at the Bush Center is around those compassionate conservative values. It is okay for a government to step in and be a rescuer, okay? But we don't want the government to be the owner. And if we come out of this process with the government owning industries, they need to divest of that as quickly as possible. And coming out of the 08-09 financial crisis, there were several cases where at the end of the Bush administration that rescue dollars were put out, and the Treasury got ownership of those companies, and the taxpayers actually made a little return on it. And that's an okay way to think about it. But you're exactly right. The model of leveraging up your sovereign balance sheet to fight a war, and then in the post-war you de-lever so that you can basically do it again. I mean, we now have such a bloated welfare state that is becoming increasingly difficult. And the United States balance sheet is one of the sources of stability on this planet. And because we had credibility that we could go fight if we needed to go fight, we could mobilize against a crisis if we needed to mobilize. The day the United States no longer has and why does the US balance sheet work? It's because Americans pay their taxes. In other countries, your tax bill is a suggestion. Okay, in the United States, we actually pay our taxes. And so we have had 60 and 70 and 80% marginal tax rates before, and we paid them. And we don't like paying them, but we have. And so that gives the markets the understanding that the US balance sheet can actually heal itself. We can't go forever though. And it's a big concern. And so we need to be a voice for fiscal moderation over time.
I'd like to see that, Ken. I really would. And we appreciate your time and joining us. Jim, it's always great to visit with you this way, even though we're not sitting next to each other.
Thank you, Ken.
All of you join us. And as you know, we're always talking about things that matter with people who care. And today, things really matter. So thanks for joining us.
For more information, call 214-750-5157 or email Nikki N at nikkimcquistion.com. Visit our website at www.mcquistiontv.com. You can also follow us on Twitter at www.twitter.com/McQuistionTV or download McQuistion TV video podcast on iTunes.